Okay, I'm very excited to have on the Goldstein on Gelt show Bob French, who is the Director of Investment Analysis at McLean Asset Management. He also writes at retirementresearcher.com. Now, I think a lot of people need to be reading about retirement because there's so much confusion. One of the things we talk about here a lot on the show is the importance of saving for retirement. And one of the things, Bob, I know that you talk about is the importance of knowing how to get the money out of your retirement accounts. What's the best strategy for people who are at the age when they have to start withdrawing money from their retirement accounts?
Yeah, and this is actually something that, we spend a lot of time talking about, largely because it's one of those where you don't think about it, then you think about it, and it seems relatively simple, and then you think about it some more, and it gets really, really complicated again. So if you're just purely looking at your investment accounts, which, you want to be looking at more broadly the totality of your whole retirement income situation, both your investment accounts, as well as, reliable income sources such as a pension in the U.S. Social Security, any annuities that you might have, kind of those things that have a guarantee, but also kind of your rainy day funds, the reserves is what we normally call them. But from the investment perspective, you really want to be focusing in on the tax situation you're looking at, how to maximize the benefit that you're going to be getting from using your different accounts in the correct order. There's some general guidelines, but, just like everything with taxes, you really want to kind of be looking at it with a CPA and looking at it from your own specific perspective.
All right, so don't try this at home, but what would you suggest in general people should be looking at? Let's say someone's got a pension or a 401k and an IRA and a Roth IRA.
Right.
Where's the first place that he looks to get some money?
Yeah, so obviously, use your pension first. You got that money coming to you. But when you do have to tap your investments, the general, and I stress that, the general order is use your taxable assets first, then your tax deferred, such as, traditional IRA, traditional 401k, and then your tax exempt assets, so your Roth accounts. And the basic idea is to use the ones that are getting hit the most by taxes first. Your taxable accounts have that tax drag each and every year that's reducing the amount they have to grow. Your tax deferred accounts, you got a pretty big wallop when you take that money out. And your tax exempt, well, they're tax exempt. You want to get the most growth out of those things that you possibly can. So that's kind of the logic for the order. And, it's pretty straightforward if you're just looking at it from that investment perspective.
How about what types of investments to have in the different portfolios? Let's say that you do a financial plan and you decide, just to keep it simple, you want to have half your money in stocks and half your money in bonds. I'm just using a generic idea.
Yep. Which
account should you have which one in?
Yeah, so asset location, what we call this, is actually something that a lot of people ignore, but is actually really, really important, especially if you look at it over long periods of time. It can really impact what those required minimum distributions are once you get into retirement. Because obviously, different assets that you have are going to have different rates of return. They're going to grow at different rates. What you really want to be trying to focus on is maximizing the total return, the total net return across your portfolio. What this really boils down to is, in that situation you just mentioned, half in stocks, half in bonds, where you got a taxable account and a tax deferred. You're going to want to stuff as much of those bonds into that tax deferred account as you possibly can, and keep those stocks in your taxable account, because the tax drag on stocks is a lot lower than the tax drag on bonds in most cases. So you're going to be taking a bigger penalty by putting those bonds in your taxable account than you would by putting the stocks in the taxable account.
Mm-hmm. We're talking with Bob French, who writes at retirementresearcher.com. He's the Director of Investment Analysis at McLean Asset Management. He's been talking to us about strategies for managing withdrawals from your pension plans or your retirement plans. I want to touch on something you just said, just to clarify. You pointed out that, let's say that you're going to have two different asset classes, and we're just oversimplifying for the sake of our discussion. You'll have stocks and you'll have bonds. And you said to put the bonds into the IRAs because presumably the tax on the current interest that you receive will then benefit from being inside an IRA, and you won't have to pay tax on that. Now, that's an interesting concept in a time when bonds actually pay pretty good yields, but do you think that still applies today when bond yields generally tend to be low? And a lot of times stock portfolios have dividends that top the yield on bonds.
Yeah, I do actually, because I don't know how the Israeli system is set up, but in the U.S., with your tax-deferred accounts, the IRS wants to get paid. The government wants its money. So there's these things called required minimum distributions. So once you hit 70 and a half, or the year you turn 70 and a half, you have to start taking money out of your IRAs, of your traditional IRAs. And generally, you're going to want to reduce that amount, if at all possible, just for, if nothing else, flexibility. You have more control over your tax situation at that point. So what you're going to want to do is, put those bonds into your tax-deferred accounts, your traditional IRAs and 401ks, so that those accounts, don't get as big. It's a very nice problem to have, admittedly, but it is still a problem. Mm-hmm. It is still something you can be using to manage your situation. In fact, if we add in Roth accounts, your tax-exempt accounts, you're going to want to stick the lower returning tax inefficient assets into your traditional IRA and the higher returning tax inefficient assets into your Roth accounts. So, you'll put things like REITs, or if you happen to be using them, commodities or different things like that into your Roth accounts, and keep the bonds in your traditional IRAs and 401ks.
And again, the idea here is not that there's a specific allocation that would be right for everyone, but rather if you are going to have, for example, bonds, the logic is if you put the bonds into your traditional IRA, where eventually you're going to have to start taking the money out as a required minimum distribution because the IRS requires that of everyone, you're going to want to be taking out smaller amounts from there so that you pay less in tax, whereas other assets which might be taxed at a more friendly rate, like stocks, which would hopefully be taxed at a capital gains rate, right, which presumably is lower than the rate that you would pay on interest or dividends, those you would want to put into a taxable account. And also it gives you more flexibility, because if you have stocks and maybe some of them went down one year and you could sell them at a loss, you could use that to offset the gains. I will note, for people living in Israel, it's even more complicated. And I'm going to go back, Bob, to what you said earlier is, don't try this at home. Make sure you get a CPA involved, because both the U.S. and Israel, if you are a dual citizen, are going to try and tax your accounts. They don't double tax, but sometimes it can be a little complicated. And if you do it wrong, you do end up paying tax twice. Bob, let's look over a different concept, because I know that you've written a lot in order to help people figure out how much money they can take out of their portfolio. And some people are so nervous, they only want to live on the dividends or the interest. And some people are looking for how they could really live it up. There's kind of a difference between a safe withdrawal rate and an optimal withdrawal rate. How do you differentiate the two, and how can a person really decide?
Yeah, and that's kind of the $1 million question, or for a lot of people, more than $1 million.
Hopefully, you have $1 million to ask that question on. Yeah.
Whenever you're dealing with the stock market or financial markets in general, to be very clear, there's no safe is always a relative term. There's no guarantees involved here. So obviously, people have been talking about the 4% rule. That when you retire, you can take out 4% of whatever you have every year, kind of adjusted for inflation, and be pretty safe. Wade Pfau, another person who writes at retirementresearcher.com and a principal at McLean, he's kind of starting to throw some water on that rule, and maybe that's a little bit aggressive. Maybe we want to be looking at 3.5% or 3%. And I'm always hesitant to use numbers here. You're safe with a 3%. Well, that's based on historical data. That's the best data we got, but I don't know that I'd rely on it to that level of specificity going forward. Maybe the U.S. just had a really, really good century. And, that's getting picked up since most of our data starts in 1926 or 27. And maybe we're not going to have such a great century going forward. Maybe our rates of return are going to be lower than they are. I don't know. I have no insight on what rates of return are going to be in the future. So what I want to do is I want to set up a situation where I'm relatively confident that I'm going to be able to get this data. And this is why I mentioned at the beginning, you need to be looking at the totality of your retirement income situation. You'd be looking at those reliable income sources like your pension and annuities and anything you have kind of an actual guarantee on, as well as your investments. So you have those reliable income sources kind of backstopping your core expenses, the stuff that you actually need to be able to live. And then you have your investments, your diversified portfolio, filling out kind of those less essential expenses. So what we actually use, we kind of use Monte Carlo analysis to try and find out, okay, we're not really so much looking at the distribution rate. What we're looking at is, okay, how likely is it that this plan we're building for someone is going to succeed? So we're not looking at, 2.5% of your money every year. We're looking at, okay, you want to be able to spend $150,000 a year. You got these reliable income sources, and the rest has to be made up by your investments. Does that work? Is that feasible? How much risk is actually involved there?
And that, in fact, is the $150,000 question for that client. Bob, you've actually covered a lot. You've also touched on issues like Monte Carlo simulations. I know that you write a lot about this, and unfortunately, we are just about out of time now. So tell me in the last few seconds, how can people follow you and follow your work?
Absolutely. You can always find me at retirementresearcher.com, where both Wade and I and some other folks at the firm here are putting out a lot of stuff all the time. So always new stuff to read there. You can also follow me on Twitter at Robert_French. And we'd love to see you around and absolutely answer any more questions that anyone has here.
All right, super. Thank you very much, Bob. We will put links to all of that at the show notes of today's show at goldsteinongelt.com. Bob French, thanks so much for your time.
Thank you, Doug.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.